Okay, it's 11 o'clock, so might as well get going. So our guest this week is Jonathan Hick, who's the manager of Triple Point Energy Transition. So he's got some interesting views, I think, to talk to us about the renewable energy sector and the whole sustainability thing. So before we get there, a few bits of news. If I feel grumpier than normal, that's because of the first one, Civitas social housing. We'll talk about that in a second. And then I want to talk about abrdn Diversified Income and Growth, because obviously that's got a strategic review coming up, and Monk's results. So Civitas social housing first. As you know, we were quite annoyed to see this sort of opportunistic bid made, especially by the group behind the manager, and especially annoyed to see the board immediately roll over and accept it. And the reason what I was upset about it in particular was because there's this huge valuation gap. There's 175 million pounds worth of value being left on the table here for the bidder to acquire, which is an enormous amount of money. And it just seems strange to me people roll over and accept, but nevertheless they have. So as it's the normal way of these things, I know all the way through that there's very little of skepticism, and then even yesterday they went percentage to 2%ish. But most people put their forms in for the coming at the last minute. They got 64.2% of the shares accepting the offer in the end. They'd already bought 17 of those. They had the bits and pieces of the managers and the directors as well lined up. So that takes them over the 50% mark. Originally, they said that be unconditional at 75%, but they've lowered that line to 50%. So that means that the bid will now go ahead with 64% of the shares going across. But because now the circumstances have changed for everybody who wants to be a shareholder, they're going to keep the offer open, so you've still got time to accept the offer if you want to. Now, in terms of what that means in practice, if they don't get to 75%, they can't delist it or liquidate it. So minorities can block that. They have to get to 90% before they can force the minority shareholders to sell. So in some circumstances, it's not a bad idea to carry on as a minority shareholder. But if you're a small one, if you're a large minority shareholder, especially if you've got enough to kind of block things like this, then there's a reason to hang on and be awkward. But I think for small shareholders, there's not a lot of wiggle room. And so my decision really is I'm just going to accept this bid. I, as I say, very quite frustrated about it. I do wonder, though, whether that just opens the floodgates for more cheeky offers. If people are prepared to hand seek a big car, 175 million quid for very little, then yeah, you can kind of go at all sorts of things. Maybe somebody like to back me to do one of these things. So I've got like 175 million pounds. But there we go. I will take the cash out, and then there are obviously quite a lot of things you could reinvest that money into. I mean, the most obvious one would be Triple Point social housing, because it's exactly the same thing on a 60% plus discount, massive yield. It's had a bit seems to me to be a bit more accident prone than Civitas social housing, but the fundamental model is the same. So as Jens is quite happy to sell out, he says there, take the cash out and buy new things. So I think it's going to be the way forward for most people now. There we go. So abrdn Diversified Income and Growth, that is the 10-year chart, which does not look great. And you can see the NAV slowly declining there, and the share price going down with it, and the big discount opening up as we go through here. Obviously all not great, but I thought this is the chart going all the way back to 95. We haven't got the NAVs back that far because the Come Fair NAVs only started in 2008, I think, which is where the green line starts. Basically, the share price now is all the way back where it was in 1995, which is quite depressing, really. I think it's about as long as I've been sort of, investing in the sector. If you think you'd own shares in that and not made any money at all, I mean, obviously they're dividends off the back of it, and quite high dividends too. But nevertheless, this is a pretty poor result, especially given inflation. So it's had a long and checkered history. It was British Assets Trust, run by Judy Dent, for about a decade. She handed it over to Phil Dole. This is all at F&C. It was a global equity income fund, but for no logical reason, it had more than 60% of its assets in the UK. And sometimes it helped and sometimes it didn't, but actually it was a massive bet relative to global equities. And actually this fund performed quite badly. And the board sort of got some maximum frustration with it in 2014. And then in 2015, it was handed over to BlackRock as BlackRock Income Strategies. And shrunk a bit then on a 20% tender offer. It didn't last very long there. And I'm not quite sure why. I mean, obviously the performance wasn't great there either. But the board got quite antsy quite quickly and decided to move on. So in November 2016, they agreed to merge it with Aberdeen UK Tracker, do another 20% tender offer, and brought in Mike Brooks and Tony Foster to run a multi-asset portfolio for it. And again, that didn't really work. And so fast forward to October 2020, and they decided they were going to put more private markets exposure there, and hand over the reins to Naka De Silva, who you've seen interviewed on the program here before. And shareholders approved that in February 2021. And it is now really a fund of private markets stuff with some equities. But it's only been doing that for just over a couple of years. And you can see all the way through here a constant history of ripping up something because it wasn't quite working, doing something completely different, finding that didn't work either, finding that doing the whole thing again. And so long-suffering shareholders have really, they've gone nowhere. It was all about income. The income, I think, got cut at one point. And the performance has been dreadful. And it's none of these people have had a chance to prove whether they were any good or not, because they just didn't have enough time to do it. And yet again, we've got the same thing here. So I think that's incredibly frustrating, but I'm not saying that means that I'm arguing that it should carry on going. Because of all of this, it's shrunk and shrunk and shrunk and shrunk, so it's down to 260 million. I did joke with somebody the other day that basically, if they just made it a proper global equity fund, a proper global equity income fund, all the way back at the beginning, and maybe change the manager, that would now be £1 billion fund and one of the leaders in the sector. But there we go. What can we do? It is now. They're starting to think it's becoming too small and trading on about 25 discount. And it's in this flexible investment sector we were looking at last week. And when you look at 5-year return numbers, it's down there, just shy of the midpoint. Not great, and definitely not great over 3 years and over a year. This is the thing that they're sort of saying they're going to abandon. Targeting 6% returns on average over a 5-year period, with a portfolio that's got quite a low correlation to equity markets and some kind of inflation protection. And they were making encouraging noises about it, even in the interim results released on the 7th of June. So they're saying there, we continue to believe that the company's well placed. But I think one or two big shareholders must have been stirring and saying, look, everybody else around you is busy doing strategic reviews or merging things. Maybe you should be doing the same thing. The reason cited is the discount and the fact that they can't grow it. And they suggest they'll listen to all sorts of options. They want to talk to shareholders to find out what they want to do. But one of the options is a combination with an existing investment trust, which seems like the most logical thing. This is where the portfolio is now. So more than half in private markets, some equities, some fixed income credit, and the private market stuff is for the most part invested in funds. So you can see there individual funds. Now that's important because there is a secondary market in funds. So if they've made direct investments, direct co-investments into things, that would be a much more illiquid portfolio. It might be possible to sell interests in these things in the secondary market, but probably not for asset value. So just worth bearing that in mind. So it is quite hard to tell how liquid that portfolio is. One of the analysts this week mentioned the fact that it's still got this expensive debenture, which actually is looking less expensive than it was. And actually that's a good point, because now if they want to, they've already paid quite a lot of money to shrink that debenture down. If they want to pay that off now, the penalty for doing that wouldn't be all that big at the moment. So to get rid of that would be quite easy. I think that whatever happens, shareholders are going to want to have a cash exit, and their 20% tender offer thing they've done in the past is not going to cut it. So I think it might have to be 100% cash exit option. And looking around, I just think it's unlikely that the portfolio that it's got would fit with another fund perfectly. There are other funds to be multi-asset. Obviously, we know we just looked at the flexible investment sector. Few of those are actually doing private market investments. A lot of those wouldn't want to go get any bigger. So yeah, we'll have to wait and see what happens in terms of who the candidates are. In terms of practicalities, which I wrote on the news story when we published this, merging things, we said before, on discounts is not a problem at all, because you just do it on a formula asset value to full asset value basis, and just stick the two together, and it doesn't matter that one fund's trading at a discount. Although obviously if you've got a cash exit option, people are more likely to tick the cash exit box. And also you can rearrange the whole portfolio without it impacting the existing shareholders of the other fund, just by holding things completely separately in a separate class of shares. So if you just stick the illiquid stuff into that pool, gradually set it off, and then give people the option to take cash out or switch into whichever the combination fund is, then that's completely doable. I think it's likely that the adding shareholders are going to have to bear the costs of all of this, and so whatever the NAV is, I think you're probably looking at taking about 2% off it as a minimum, but we'll wait and see on that. The problem that we've got is, in terms of using mergers as a solution, is that just about every investment company that's invested in private assets is trading at a discount. So it's not going to fix the problem. So the only thing that does fix the discount problem is just liquidating the thing. And if that's going to be the case, then the obvious people to do that are the existing abrdn management team. And so that's probably where I think it's going to go. We'll just have to wait and see on that. I think it might take some time to do, but you might get a big chunk of money out relatively quickly. And as Jens said on Civitas, there's plenty of other things to buy. Monks now. Obviously, all the Baillie Gifford funds have been carted out. It is showing some signs of life, though. If you look at the 1 year figures here now, yeah, it is up now, sort of ranking 5 out of 13 funds. So it is perking up a bit. And the 10-year figures still look quite good, because obviously it had quite a good run before that. But 3 and 5, no, down towards the bottom of the table. The results this week, we weren't expecting anything spectacular, and they were behind the benchmark, but not a lot behind the benchmark, which is the world index. And the problem obviously is that the discount widened a bit. They have tried to do something about that, so they've been buying back shares, and that added about 0.5% to the NAV, which so the NAV has been worse apart from that. But nevertheless, the discount is a bit wider than it was, so there is a sort of investment opportunity there if you want to seize it. There's not much of a dividend from this thing, and that's although so we know we've got a decent uplift, and that just by the by. Now there's a few sort of interesting comments, and that's the reason I wanted to highlight this stuff. So one is that there's a lot of kind of mea culpa stuff going on. The chairman's acknowledging that they've made mistakes. and it hasn't quite worked. The idea of Monks is that it's a much less racy version of what they do in the other funds, so it's balanced with different sorts of investments. Interestingly, there's a quote from the chairman saying that they're comforted by the lack of exposure to unquoted companies, which to me feels like a dig at all the other Bernie Gifford funds. But nevertheless, that obviously has been helpful given what we were saying about the discounts of private market assets. And the other thing is that there's a strong sort of hint here that the board thinks the problem is that the manager was overpaying for stuff or not selling things when they were at sky high prices that were unrealistic. That seems to be what the direction of that valuation discipline, that comment means. As managers say, yeah, we know we've made some mistakes, which is always refreshing to see. But they're also quite adamant that there is a lot of value in the portfolio. And I think that's important because that's also, we're hearing that from a lot of other growth managers too. So they don't think the share price weakness reflects the underlying progress in their companies. Their companies are growing much, much faster than the market. And as I say, this is more interesting in some ways than the Scottish mortgage, which is just all growth. This is growth, but it's different buckets and different things. So the rapid growth stuff is probably more akin to the normal Bernie Gifford stuff. But they also hold a bunch of things that are growing companies that actually chuck off a lot of cash. So things like Microsoft. And a big position in Microsoft is one of the things that's massively helped out here recently because of that whole AI uplift and that sort of thing. Moody's, the rating agency, Panera Car Drinks. So those sorts of things that are growing, but maybe not that fast, but generating cash. Nice sort of defensive type things. I think that's not a bad place to be at the moment. They've still got quite a big chunk in this sort of rapid growth stuff, but that's down from 40% exposure last time. They said most of that came from valuation falls. But it's things like Tencent, that's what Process is. Process is just a holding company that owns Tencent. Amazon Schiharian, which is the Bailey Gifford fund of unquoted growth stuff. And that actually accounts for a big chunk of Monk's unquoted exposure. And then they've also got this cyclical growth, which is things like building materials and miners and house builders and travel stocks, things like Ryanair and Persimmon and CRH and stuff in there, which looks like a more normal global equity portfolio. So all of that means it's much more balanced, and I do think that makes it a much more interesting fund. It's one of the things that I have as sort of like a core holding in what I do. I do quite like Monks. So there we go. That's enough from me. There's just one question here that we've got here. So on ADIG, there was some restructuring in the Aberdeen Alternatives Group. Is that related? No, I don't think it is. I think this has come from the board because they've been made up by shareholders rather than from Aberdeen. That's my understanding anyway. Good.